Merry Christmas, ladies and gentlemen. Asian guy here. I know what you are doing right now. You're probably sitting on the couch, digesting a heavy meal. Maybe the kids are playing with their new toys. Maybe you are having a drink with your relatives. You are checking your phone, looking at the silver price, and you see it sitting there. Flat, peaceful. It is trading around $71.94 to $72.10. It hasn't moved an inch in 24 hours. The charts are frozen. The noise has stopped. For the first time in 12 months, the screaming volatility of the silver market has gone silent. It feels safe, doesn't it? It feels like the war is over for the year. It feels like you can finally relax, close your laptop, and wait for January. But I'm turning on this camera on Christmas night because I need to tell you something that your broker will not tell you. I need to tell you something that the financial news channels, who are currently airing pre-recorded year-in-review fluff pieces, are completely ignoring. This silence, this peace, it is a lie. We are currently standing in the eye of a hurricane. And tomorrow morning, December 26th, the eye wall hits. We are entering a specific, dangerous window of time that professional traders whisper about. We are entering the period known as Ghost Week. If you have been trading for less than 5 years, you might not know what this is. You might think the market is just closed or open. You might think a Tuesday is the same as a Friday. But in the futures market, in the brutal, leveraged world of the COMEX, time is not linear. Ghost Week is the trading period between Christmas Day and New Year's Day. Specifically, it is the trading sessions from December 26th to January 2nd. During this week, the entire structure of the global financial system changes. Think about who moves the market on a normal Tuesday. It is the senior risk managers at JP Morgan. It is the head traders at Bridgewater. It is the sophisticated algorithmic desks in London and Hong Kong. These are people with decades of experience. And more importantly, they are people with the authority to deploy billions of dollars of capital to stabilize prices. But right now, those people are gone. They're in Aspen skiing. They're in St. Bart's on yachts. They're with their families. They have turned off their terminals. They have flattened their books. They have handed the keys to the castle to the skeleton crew. The skeleton crew is made up of junior traders, interns, and automated maintenance algorithms running on low power mode. Their instructions are simple. Don't do anything stupid. Just keep the lights on until the boss comes back in January. This means that the volume, the amount of money flowing through the veins of the market, drops by 70% to 90%. And this creates the most dangerous phenomenon in finance, the liquidity vacuum. I need to explain the liquidity vacuum technically, because if you are holding leverage right now, this concept is going to determine whether you get rich next week or whether you get liquidated. Imagine the silver market is a frozen lake. On a normal day, the ice is 10 feet thick. You can drive a truck over it. If a massive sell order comes in, say someone sells 5,000 contracts, the ice holds. The price dips maybe 10 cents, and then the limit orders absorb the shock. The limit orders are the walls of the market. There are thousands of traders waiting to buy at $71.90, $71.80, $71.70. These orders act like a buffer. They cushion the blow. But during Ghost Week, the ice melts. It becomes paper thin. Because the senior traders are gone, those thousands of limit orders are removed from the order book. The walls disappear. So now we have a market with zero depth. If a large order hits the market tomorrow, let's say a sovereign wealth fund decides to rebalance their portfolio, or a panicked hedge fund needs to cover a short, that order will not find a buyer at $71.90. It won't find a buyer at $71.80. It might have to drop all the way to $68 just to find the first willing buyer. And we call this slippage. We call this an air pocket. And it works both ways. If a large buy order hits the market tomorrow, maybe because of a headline in Venezuela, which we will discuss in part 2, the price won't tick up to $72.10. It will teleport. It will gap from $72 straight to $75 in a single 1-minute candle. Why? Because there is nobody standing in the way to sell it. The sellers are on vacation. So Ghost Week is not a time of peace. It is a time of extreme fragility. The market is like a room full of gasoline fumes. It looks calm, but one single spark, one tweet, one headline, one rumor can blow the roof off the building. You might be thinking, Asian guy, you're exaggerating. Nothing happens during the holidays. Oh, really? Let's look at history. Christmas 2010. Silver was trading quietly around $29. Everyone went on holiday. By the first week of January 2011, silver had ripped violently higher, igniting the run that took us to $50 on April. The Ghost Week was the launch pad. Christmas 2020, the beginnings of the silver squeeze started bubbling up in thin trading. By late January, we were gapping up on Sunday opens. Flash crash of 2019, yen. Remember the flash crash in the Japanese yen that happened on January 3rd during the Asian holiday window? The yen moved 4% in minutes. Why? Because there was no liquidity. History tells us that Ghost Week is when the unexpected happens. It is when the fat tails of probability distribution show up. And 2025 is not 2010. In 2010, the world was relatively stable. In 2025, we have a proxy war in South America. We have a blockade on Venezuela. We have a Fed that just capitulated on inflation. And we have a silver market that is up 140% year to date. The potential energy stored in this market is higher than it has ever been. We are sitting on a coiled spring. Let's look at the board as it stands tonight, Christmas 2025. We have closed the week at an all-time high of $71.11, spot high. We have successfully broken the iron ceiling of $70. The psychological impact of this cannot be overstated. For 45 years, $50 was the ceiling. Once we broke that, $70 became the new mental barrier. Now, we are above it. Technically, we are in blue sky territory. There is no resistance above us. There are no previous bag holders looking to sell. The only people left in this trade are the winners. But here is the danger. The RSI, Relative Strength Index, is screaming overbought. The Daily Sentiment Index is at 95% bullish. In a normal market, this would scream pullback. It would scream profit-taking. And usually traders would take profit. They would sell before the end of the year to lock in their bonuses. But this year, they aren't selling. Why? Because of the Asahi Vault drain we saw on December 23rd. The smart money knows that there is no physical metal left. They know that if they sell their paper contract at $72 to take a profit, they might never get back in. They might wake up on January 2nd and see the price at $85. So nobody is selling. Everyone is holding their breath. We have a market with maximum bullish pressure confined within a minimum liquidity environment. It is the physics of an explosion waiting to happen. So what happens tomorrow? December 26th? The markets will open for a shortened session. Volume will be virtually non-existent, but the arbitrage bots that connect New York to Shanghai will still be running. Remember, Shanghai is trading at $77. New York is at $72. That $5 gap is effectively a bungee cord pulling New York higher. Tomorrow, even with low volume, that bungee cord is going to be pulling. If just one industrial buyer, maybe a battery plant that didn't shut down for Christmas, decides to hedge their January delivery tomorrow, they could send the price vertical. And if we gap up tomorrow, it sets the tone for January. It triggers the FOMO for every institution that is currently sitting on cash. But there's one variable we haven't discussed yet: the trigger. A liquidity vacuum is dangerous, but it needs a spark. It needs a catalyst to ignite the gas. While you were eating your Christmas dinner, something happened in the Caribbean. While you were opening presents, the U.S. Navy made a move that has not hit the mainstream news yet. We are seeing reports of a new escalation in the Venezuela blockade. And this escalation involves a tanker that doesn't belong to Venezuela. It belongs to a nuclear power. 3 days ago, the U.S. Coast Guard intercepted the tanker Bella 1. Yesterday, they boarded the Centuries, a vessel owned by a Hong Kong-based company. Do you understand the significance of this? Hong Kong is China. The U.S. military just forcibly boarded a Chinese-linked vessel in international waters to enforce an oil blockade. This is no longer just about sanctions. This is a direct provocation between superpowers in the Western Hemisphere. Moscow has already issued a statement backing Maduro. Beijing is silent, but their silence is deafening. Russia and China are the primary buyers of this oil. They are the ones whose supply chain is being cut. Now, why does a boat in the Caribbean matter for the price of silver tomorrow morning? Because silver is a war metal. When missiles start flying, or when navies start blocking shipping lanes, the algorithms that run the global macro funds have a specific instruction: sell risk, buy havens. Usually, they buy the US dollar. But look at the dollar index, DXY. It is trading at 97.94. It is at a 12-week low. It is down nearly 10% this year. The world doesn't trust the dollar as a safe haven right now because the dollar is the weapon being used in the blockade. So where does the money go? It goes to gold, and it goes to silver. If we wake up on December 28th to a headline that a Russian naval escort is moving toward Venezuela, or that China has issued a formal warning, the fear bid will hit the market. And remember, part one, there is no liquidity. If $1 billion of fear money tries to squeeze into the silver market on a holiday week, it's like trying to push a watermelon through a garden hose. The price won't just rise, it will explode. But the war trade is just the left hook. The knockout punch comes from the Federal Reserve. We need to talk about what happened right before the holiday. We need to talk about the Fed surrender. Federal Reserve Governor Christopher Waller gave a speech that effectively waved the white flag. Inflation is currently stuck at 2.7%. The target is 2.0%. In a normal world, the Fed would be raising rates to kill that inflation. But Waller signaled that the market should expect 2 more rate cuts in 2026. Think about that logic. Inflation is above target. Unemployment is rising, 4.6%. And the Fed is cutting rates. They are admitting that they cannot fight inflation anymore. They are admitting that the debt, the 36 trillion US debt, is so high that they must cut rates to keep the government solvent, even if it means letting inflation run hot. This is the most bullish signal for silver possible. Silver thrives in an environment of negative real rates. Interest rate, 3.75% real inflation, shadow stats. Approximately 8 to 10% official inflation, 2.7%. No matter how you do the math, if you hold dollars, you're losing purchasing power, and now the Fed has confirmed they will print more money in 2026. This is why the dollar index is crashing during the holidays. The smart money is exiting the dollar before the new year starts. So let's put the pieces together for next week. On one side, we have the spark, a dangerous escalation in Venezuela involving China and Russia, driving panicked capital into safe havens. On the other side, we have the fuel, a Federal Reserve that has surrendered to inflation, crashing the value of the dollar and forcing investors into hard assets. And in the middle, we have the vacuum, Ghost Week, a market with no sellers, no liquidity, and no depth. If these three things collide on Tuesday morning, we are not looking at a $1 move. We are looking at an $8 gap up. We are looking at silver opening at $80 and never looking back. I want to be balanced. Is there a downside risk? Of course, if the Venezuela situation de-escalates. If the skeleton crew at the banks decides to take profit to secure their year-end bonuses. We could see a flush down to $68. But ask yourself, who is selling? Is China selling while their ships are being blocked? No, they are buying silver to de-dollarize. Is the Fed selling? No, they are cutting rates. The path of least resistance is higher, much higher. But even if the price does drop, it won't stay down. While the politicians are fighting over tankers, something terrifying happened in the vaults of New York. On December 23rd, just 48 hours ago, one of the largest vaults in the COMEX system was raided. 1.4 million ounces vanished overnight. You can print dollars, you can print rate cuts, but you cannot print 1.4 million ounces of silver. Go search for the official CME silver stock report. Usually, inventory moves are boring. 10,000 ounces in, 10,000 ounces out. It's noise. But look at this line item. Asahi Refining. Minus 1,402,453 ounces. In a single day, over 1.4 million ounces were removed from the registered category at Asahi. Registered means the metal is available for delivery against a futures contract. It is the for sale pile. On December 23rd, someone walked into the Asahi vault, pointed at 1,400 bars and said, "Mine, take them off the market, now." And they weren't alone. JP Morgan Vault, minus 597,993 ounces. CNT Vault, minus 228,780 ounces. StoneX Vault, minus 24,984 ounces. In total, over 2.2 million ounces of liquidity evaporated in 24 hours. Now, why does this matter for Ghost Week starting tomorrow? Because usually, when the price hits an all-time high, $71.11, inventory increases. Why? Because people sell. If you bought silver at $25 and it hits $71, you sell it to the vault to take your profit. The vault should be flooding with metal. But the opposite is happening. Price is at a record high, and inventory is leaving at record speed. This is the definition of a cornered market. The entities taking this metal, we suspect it is a mix of sovereign wealth funds and battery manufacturers, do not care about the price. They care about possession. They know that Ghost Week is coming. They know liquidity is drying up. So they raided the vaults before the holiday to ensure they had the physical metal in their hands. This creates what I call a hard floor under the market. People are terrified of a crash. They ask, what if silver drops to $60 next week? Let me explain why that is mathematically impossible. Right now, the price in Shanghai is trading at roughly $77. The price in New York is $72. That is a $5 spread. If the price in New York drops to $65, that spread becomes $12. Do you know what happens then? Every arbitrage bot, every bank, and every trader on earth will buy New York instantly to sell to Shanghai. It is free money. It is a risk-free trade. This arbitrage magnet acts like a safety net. It catches the price. And because the inventory, Asahi, is being drained, the safety net is getting tighter and tighter. So even if we get a flash crash during Ghost Week, it will be bought up in seconds. The physical demand is simply too strong to allow the paper price to collapse. But here is the truly dangerous part for the banks. Because 1.4 million ounces just left Asahi. The float is smaller. The float is the amount of silver available to trade. Tomorrow, the options dealers have to hedge their positions. They are short call options at $72 and $75. If the price gaps up, they need to buy futures to hedge. But where will they get the contracts? The metal backing those contracts just left the building. This is how you get a gamma squeeze. The dealers are forced to buy, but there are no sellers. Inventory is gone. So the dealers have to bid higher. $73, $74, $75. And the higher it goes, the more they have to buy. It is a feedback loop from hell, and it is happening during a week with no liquidity. So do not let the quiet price action fool you. The vault data proves that the smart money is panicking. They're securing metal at any cost. They drained Asahi on Tuesday so they wouldn't be caught naked on Monday. But what does the chart say? We have the fundamental driver, war. We have the supply driver, vault drain. Now we need the technical confirmation. Look at where we are today. Look at the price on the screen, $72. Do you see any lines above the current price? Do you see any previous peaks? Do you see any bag holders from 10 years ago waiting to sell? No? We are in what is technically known as price discovery mode. I call it blue sky. And in blue sky territory, the laws of gravity stop working. You have to understand how markets usually work. When price goes up, it hits resistance. Resistance is just a fancy word for people who bought at this price years ago and want to sell to get their money back. At $30, there were sellers. At $50, there were massive sellers. But at $72, there are no sellers. Every single person who has ever bought an ounce of silver in the history of the human race is currently in profit. Nobody is trapped. Nobody is desperate to sell to break even. This creates a vacuum of selling pressure. And when you combine a selling vacuum with a buying panic from the war catalyst, you don't get a trend. You get a vertical line. Now, let's talk about the robots. 80% of the volume on the COMEX is high frequency trading, HFT, and CTA, commodity trading advisor algorithms. For the last 15 years, these bots were programmed with a simple instruction. If silver hits resistance, short it. They made billions fading the rallies. But tomorrow morning, when the Ghost Week market opens, those algorithms are running a different code. Their breakout module has been activated. The logic is simple. If price all-time high plus volatility expansion, initiate maximum long. The robots are no longer fighting the trend. They are chasing it. And robots don't care if the price is expensive. Is $80 expensive? The robot doesn't know. Is $100 expensive? The robot doesn't care. The robot only knows that the price is making new highs, so it buys. And because there is no liquidity, Ghost Week, the robot's buying pushes the price higher, which triggers more buying. This is the algorithmic feedback loop that creates a gap up. Now, I know what the skeptics are saying. Asian guy, look at the RSI. It's at 85. The market is overbought. It has to crash. Let me tell you a secret about overbought signals in a bull market. They are a trap. In 1980, silver entered overbought territory at $15. Did it stop? No, it went to $50. It stayed overbought for 5 months. In 2011, silver entered overbought territory at $28. Did it stop? No, it went to $49. In a parabolic move, which is what we are in right now, an RSI of 85 doesn't mean sell. It means the trend is violent. If you short this market because of an indicator you learned in a YouTube tutorial, you're going to get run over by a steamroller. The market can stay irrational longer than you can stay solvent. And right now, the market is not just irrational, it is structurally broken. So here's what I expect to see on the charts next week. Because of the low volume, we won't see a smooth curve. We will see steps. On Monday, the price might close at $72. On Tuesday, if the Venezuela news breaks, the first trade might print at $75. That is a $3 gap. Why? Because the algorithm looks for a seller at $72.05. Finds none. Looks at $72.10. Finds none. It keeps scanning up the order book until it finds the first guy willing to sell. And that guy is sitting at $75. So the price teleports to $75. This leaves a gap on the chart. And while traders usually say gaps must be filled, in a supply crisis, gaps can stay open for years. But we're not the first people to trade through a holiday squeeze. This has happened before. Now, I want to take you back in time. I want to show you the charts from Christmas 2010 and Christmas 2020. History doesn't repeat, but it rhymes. And the holiday squeezes of the past tell us exactly what is about to happen to the price of silver in January 2026. But I will warn you, the setup today is 10 times more explosive than 2010. Skeptics love to say, nothing happens during the holidays, it's a dead zone. Go back to sleep. I am here to tell you that is a lie. Some of the most violent, trend-defining moves in the history of silver began exactly during this dead zone. The Ghost Week is not a time of sleep. It is a launch pad. I want to take you back in time to two specific Christmases. Christmas 2010 and Christmas 2020. These were the ghosts of Christmas past. And they are screaming a warning about what is about to happen in 2026. Let's look at the chart on the left, December 2010. If you were trading back then, you remember the atmosphere. Silver had been rallying all year. It was trading around $29 to $30. The media was screaming bubble. The RSI was overbought. The banks were telling everyone to take profits before the end of the year. Most traders listened. They sold. They went on holiday. But what happened between Christmas and New Year's? The price didn't dip. It drifted higher. $30, $30.50, $31. Why? Because the sellers were gone, Ghost Week. But the physical buyers, the smart money, kept buying. They used the low liquidity to walk the price up effortlessly. When the traders returned from their ski trips in January 2011, they panicked. They had sold at $29, now it was $31. They had to chase it. That Ghost Week rally was the spark that ignited the parabolic run to $50 in April 2011. If you sold during Christmas 2010, you missed the greatest trade of the decade. Now, look at the chart on the right. December 2020. The world was in lockdown. Silver was recovering from the COVID crash. During the holidays, the narrative started to shift. The silver squeeze idea began to circulate on forums. Again, volume was thin. Again, the banks were absent. And just like in 2010, the price started to creep. It gapped up in early January. By the end of the month, we were seeing $30 again, and the hashtag silver squeeze was trending globally. The lesson is simple. Bull markets love holidays. When the manipulators, the banks, step away from the desk, the natural direction of silver is UP. The suppression requires constant maintenance. When the maintenance crew goes on break, the beach ball pops out of the water. But Asian guy, if it happened in 2010 and 2020, why are you so worried about 2025? Why do you say this year is danger next week? Because of one critical difference. Inventory. In 2010, the COMEX vaults were full. There were hundreds of millions of ounces available. In 2020, the vaults were overflowing. JP Morgan had just accumulated their massive hoard. In those years, the banks had ammunition. They could step in after the holiday and smash the price back down if they wanted to. In 2025, the gun is empty. We showed you the data in part 3. The Asahi Vault lost 1.4 million ounces in a single day. The swap rate is minus 7%. Backwardation. The Shanghai premium is $5. This is not 2010. This is 2010 on steroids. The rubber band is stretched 10 times tighter today than it was back then. In 2010, we rallied because of speculation. In 2025, we are rallying because of starvation. If the price gaps up next week, the banks cannot smash it back down because they have no metal to dump. They can't execute a paper smash because the arbitrage bots in Shanghai will eat them alive. We are entering a ghost week with zero liquidity and zero inventory. That is a combination we have never seen in history. Not in 1980, not in 2011, never. There's also a psychological factor at play here, FOMO. Think about the institutional managers. They are sitting at home right now. They see silver at $72. They know they are underweight commodities. They own too much tech, too much crypto, and zero silver. They are looking at the same Venezuela headlines we are. They are looking at the Fed's surrender. If the market gaps up by $3 or $4 on Monday, those managers are going to panic. They have a mandate to generate returns. If silver is the only asset moving, they have to buy it. And because it's Ghost Week, their panic buy orders will hit a vacuum. A few $100 million from a panicked pension fund is enough to push silver from $75 to $80 in an afternoon when the volume is this low. The danger for you, the retail trader, is getting shaken out right before the explosion. The banks know this history too. They might try one last head fake on Monday morning. They might try to dump a few contracts at the open to drop the price to $70, hoping to trigger your stop losses. Do not fall for it. Remember the ghosts of 2010. Remember the traders who sold at $29 and watched it go to $50. Do not be the guy who sold the bottom of the breakout because you were scared of a holiday shadow. Now, what do? How do you trade this? Do you buy at the open? Do you wait? What happens if the gap is down instead of up? This is the most important part. Because being right doesn't matter if you get liquidated. I have seen smart people who got the direction right, people who knew silver was going to $100, lose everything in a single week because they didn't respect the volatility. When the liquidity disappears tomorrow, the market becomes a wild animal. It stops behaving rationally. It stops respecting support lines. It can whip down $4 to liquidate your stop loss, and then whip up $8 in the same hour. This is the most important rule. If you remember nothing else from this series, remember this. Do not use high leverage next week. If you are trading futures with 10 times or 20 times leverage, or if you're buying short-dated call options that expire in January, you are gambling. In a liquidity vacuum, we see things called widowmaker wicks. This is when a massive market order hits the thin order book, and the price instantly teleports down to an irrational number, say $65, for exactly 1 second before snapping back to $72. If you are highly leveraged, that 1 second wick will liquidate your account. You will be wiped out at the absolute bottom, and then you will watch helplessly as the price recovers and goes to the moon without you. Do not try to be a hero next week. If you are holding paper positions, reduce your size, widen your stops. Or better yet, remove the leverage entirely. This is a week for holding, not for scalping. Ghost week is deceptive. The moves that happen between December 26th and December 31st are often noise. They are driven by skeleton crews and algorithms. The signal you need to watch is the open of the first trading day of 2026, Friday, January 2nd. This is when the big boys turn their terminals back on. This is when the hedge funds, the sovereign wealth funds, and the banks re-enter the room. The bullish confirmation: if silver opens on John 2nd and immediately breaks above the Ghost Week high, EG. Or if we trade up to $74 this week and break $74.50 on John 2nd, that is the green light. That confirms the institutions are chasing the move. That is when you add to your position. The bear trap. If we see a massive gap down on John 2nd, do not panic. Watch the $70 level. As long as $70 holds, the trend is intact. A drop to $70 on the open is likely a final shakeout to steal your shares before the run to $100. Ignore the noise on Tuesday. Ignore the noise on Wednesday. Jan 2nd is the truth. Finally, let's talk about physical silver. Many of you don't trade futures, you stack ounces. Next week is going to be weird for you. You might see the spot price on your screen drop. Maybe it flashes red. Maybe CNBC says silver crashes to $68. Do not look at the spot price, look at the premiums. In a Ghost Week liquidity crunch, the paper price can disconnect from reality. The paper price might drop, but if you go to an online dealer, the price for an American Eagle might actually go up. Why? Because the dealers know about the Asahi Vault drain. They know supply is gone. They aren't going to lower their prices just because a few algos dumped futures contracts in thin volume. My advice: if we get a flash crash in the paper price next week, treat it as a gift. Go to your local coin shop. Go to the online dealers. If they haven't updated their prices yet, buy. Arbitrage. The difference between the fake paper panic and the real physical shortage, because that window will close fast. Now, let's play out the two scenarios for next week so you aren't surprised. Scenario A, the war gap, up. We wake up tomorrow or Sunday to headlines about Venezuela. Silver opens at $75. Action: do not chase it immediately. A gap that big and thin volume often fills or pulls back halfway. Wait for the dip. Wait for it to settle. If you FOMO in at $75, you might suffer through a pullback to $73 before it goes higher. Be patient. The trend is your friend, but your entry point matters. Scenario B, the profit-taking flush, down. The market's open and traders dump positions to lock in 20-25 gains. Silver drops to $68. Action: buy the dip. Remember the $77 Shanghai price. Remember the minus 7% swap rate. A drop to $68 is technically impossible to sustain. The arbitrage bots will buy it. Step in with confidence. You're buying $1 for 80 cents. Ladies and gentlemen, we are at the finish line of 2025. It has been a historic year. We watched silver break $30. We watched it break $50. We watched it break the all-time high of $71.11. You should be proud. You survived the volatility. You held on when everyone said to sell. But 2025 was just the tutorial. 2026 is the boss level. In 2026, the inventory runs out completely. In 2026, the BRICS currency likely launches. In 2026, the Fed cuts rates into inflation. Ghost Week is the transition period. It is the deep breath before the plunge. The volatility next week might be scary, it might be violent, but if you keep your leverage low, if you keep your eyes on the fundamentals, and if you remember that 1.4 million ounces just left the vault, then you have nothing to fear. The paper silver game is ending. The real silver era is beginning. Enjoy your holidays, watch the Venezuela news, and get ready for Monday. I am John A.G. Remember to like and subscribe, and share the message to all your friends. Merry Christmas.